Aloha, everyone, and thank you for joining us today. My name is Leslie Harvey, Board President of the Hawaii Economic Association and Guild Consulting Partner. Today, we'll hear from our very own Board Director and Tax and Research Planning Officer, Seth Colby, on Governor Josh Green's Affordability Tax Plan in a comparison of the proposed version and the past version. Today's event will be moderated by Miro Grabowski, HEA Board Director and Professor of Economics at the University of Hawaii, Manoa. Before we begin, a couple of housekeeping reminders. HEA members are invited to participate in our Q&A by using the Q&A function at the bottom of the screen. This is strictly a member benefit, and if it's something you're interested in, HEA membership is only $40 for the year. However, this is a great time to join. We're running a special on membership in connection with our upcoming October annual conference. You can save on membership, either a new member or a renewal, when purchasing your membership in conjunction with your conference ticket. We have both in-person and virtual conference tickets available, so don't delay. I'll have some more information on that at the end of today's webinar. And more information, of course, is always available online on our website under events. That's hawaiieeconomicassociation.com. Heads up, today's webinar will be recorded and will be provided to attendees along with event resources after this event. At the end of today's webinar, please take a moment to let us know how we did via the feedback form. We'll share the link with you at the end, and attendees will also receive that link by email. Should you have any technical issues during this webinar, please send a direct message to me or to Mary, our HEA Administrative Support Consultant. And with that, I'd like to briefly introduce our moderator and board director, Miroslav Grabowski, before turning it over. Miroslav Grabowski is an assistant professor in the Department of Economics at the University of Hawaii at Manoa. His research interests lie in macroeconomics, particularly in furthering our understanding of the effect of search costs and other frictions on the housing market, economic growth, business cycle fluctuations, and unemployment. He's received a number of awards and honors and is a published researcher. Miro, welcome. Thank you for joining us. Turning it over to you. Thanks.
Thank you very much for the kind and warm introduction, Leslie. It is my pleasure to introduce our panelists, Seth Colby. So as you mentioned, Seth is a board of directors member of Hawaii Economic Association, but he's also the tax research and planning officer for the Hawaii Department of Taxation, where he manages the tax research and planning office. That office is responsible for producing analytical reports related to the state's revenue system, revenue forecasting, empirically based public policy analysis, among other research. So this, without any more delay, I would like to introduce Seth, who can take it away and talk to us about the state tax reform.
Hi guys, nice to see all of you again. So what I'm going to do today, so let me bring up my presentation. Is to discuss the governor's tax proposals and essentially his overarching agenda. So hopefully you guys can all see that. And the Governor Green's tax plan has basically been called the Green Affordability Plan or GAP plan. So I'm going to be using that terminology going through with everything. And so we're going to do a couple things in this presentation. One, we're going to describe what was going on when everything was first introduced. Then we're going to go over how the initial ideas, how they changed over time, what were the consequences of that, what are how did different groups benefit from different aspects of the tax plan. And we're going to see what actually passed in the legislature. And then finally, we're going to look at what actually passed, what there's a couple opportunities for the governor to move forward with different things. He's currently considering them, those options. So I'm going to talk about those things as well. Hopefully in the process, everybody is going to have a deeper understanding of how our tax system works and different dynamics of our individual income tax system. So let me begin with this. The context of these tax proposals was a new governor coming into the office with a very large projected surplus, right? And so this was giving more fiscal leeway and fiscal room than most other governors have ever had in their terms. So as anybody who's been following legislative politics in Hawaii, this last legislative session, they were able to use a lot of that surplus to devote to certain priorities through spending, and also they were engaged in several tax cuts, tax reduction measures, and we're going to go over those in this presentation. The other thing that was very high on the governor's priority list was addressing two things. One was Hawaii's overall high cost of living. So how can you bring that down? Housing is a very big push for the governor, but taxes, a lot of us don't think of taxes as a part of the cost of living, but it is. And that was one of the other pushes that the governor was interested in. The third thing that the governor was interested in was supporting ALICE families. So we're going to talk more about ALICE families, but essentially ALICE families, if you can think of the income spectrum going from the left to right, the people on the furthest left, the lowest income families, are generally people who make less than probably $30,000 a year, right? Below the federal poverty line, which I think in Hawaii is $35,000 a year. So above the poverty line is a huge swath of people that has gained a lot of attention in the legislature. It's called the ALICE group, which is asset limited, income constrained employed. Essentially, these are people who work but don't get paid very much. Right. And there are some debates about what actually is ALICE in terms of the income distribution. And we can discuss that more at length. However, that was just a very high priority for the governor. So the reason I mention all these three things is all three of these factors really influenced what the governor proposed initially and how it was pushed forward. So it's important to keep those things in mind. There was a number of potential ideas, right? When Governor Green was first coming into office, he had, as with any governorship, there was high degrees of learning and a lot of ideas swirling around. And so one of the main ideas was to actually cut the GET, give an exemption for food and medicine. And we're going to talk about that and how it compares to the final tax plan, but that's something to be thought of. Another thing that is very often done within our legislature are targeted tax cuts. These are tax cuts that are directed to certain segments of the population, or that can be income-based, or that could be industry-based. It can be a number of different things. And then there's general tax relief. General tax relief corresponds to a reduction of tax rates, usually across the board. It doesn't necessarily need to hit every single group equally, but that is just general tax relief. And all three of those ideas were considered during this time. So we spent a lot of time working with the governor and the governor's staff, and the governor said that there was three things on the top of their minds, or his mind. One was this whole idea of ALICE families, right? So 42% of families have a challenge making ends meet. And this is probably higher in reality, but there's two aspects of this 42%. One is the people living below the federal poverty line, which is 9% of households in Hawaii. The other one, 33%, is this ALICE households, right? And, we are generally looking at, and this is for a family of four, keep in mind, for families making between $35,000 and $100,000, right? So this is a dual income family. Traditionally, we think of them as with kids. So That's what it is. Just to put this in perspective, the median income in Hawaii is $88,000, right? So a large portion of these people are of Hawaii's segment of Hawaii's population is this. So this is kind of like one of the benchmarks. The other issue that a lot of people in the administration were concerned with is people are choosing to leave Hawaii, right? And who is choosing to leave Hawaii? Well, one of the main constituents of people choosing to leave Hawaii are the middle class, right? Because there are higher paying jobs and lower costs on the mainland, right? So how can we address this? And so the third is, while our tax system and a lot of our public benefits goes to the lowest income people, we were missing the ALICE segment, right? So a lot of this, of the suggestions here that were at least initially passed or initially put forward were to design to target this middle income of the middle part of the income spectrum, right? And so the solutions to all of this was to, one, increase assistance to the lowest income families, right? To recognize that usually people who with the least amount of income are enduring the greatest amount of hardship, but also design a system that allows ALICE households to benefit from this, and to provide tax relief to working families. So this is a chart that we've been showing a lot that I think gets to a lot of the issues. So these are all the tax benefits that benefit social welfare broken down by income spectrum. This is for tax filers who are married filing jointly. So this is generally for families, right? Or dual income for families or partnerships living together. For head of households was a different tax filing classification, and single filers or joint filing separate. This is a slightly different distribution, but generally the distribution for each one of these is the same. Now, what you can see is most of our tax credits go to the lowest income households, right? So these are the people to the left of this box, right? And within here is the ALICE households that we were talking about, right? So the middle part of the distribution. Not the lowest 2 deciles and not the highest 2 deciles, but the middle 6 deciles, right? And so one of the ideas is, how can we start benefiting, or how can the governor start benefiting these households? So what they did was and again, this is initially, so we're going back in time. This is not what passed. We'll go over what passed in the coming slides. It was basically built on the GAP plan. The Green Affordability Plan was built on 4 different pillars. The first was to help families struggling the most. So that's help increasing the benefits to the lowest income people, families. And these are the people that were on the lowest 2 deciles of the income spectrum that I just showed you. The other one is to support working families. So this is more the ALICE households. The third was a pretty interesting initiative, which was to increase support for working parents. So I'm going to talk about this for about 2 minutes, because this is one of the more unique aspects of the platform, which was to really boost income support for people who are paying for childcare of working parents, right? So this was the idea that 1, we have population decline. 2, it's very difficult. One of the biggest increases of inflation is actually childcare costs for a family, and this is shown for ALICE families, for everybody. So this is a tax credit to support these people and help mitigate help them make the decision on whether they want to work on or not. So one of the big things that we saw there during the pandemic was women dropped out of the labor force at a higher rates than men. And this is because of the traditional roles that women play in terms of childcare, right? So they had to make this decision between taking care of their children and working, right? Currently, Hawaii has a child and dependent care tax credit, but it's very small. That mirrors the Fed, right? So it's pretty small. If you want to do it, you can, but it wasn't really moving the needle. This is really meant to increase it. So the original proposal allowed people to get up to refundable tax credit up to $10,000 for families that were paying with 2 kids, paying over $20,000 in childcare, right? So this really boosted the benefit to 50% of childcare expenses in a lot of cases. And the idea was it was supposed to help people make the decision to stay in the workforce more. And again, because of our legacy and social roles, this disproportionately benefits. This tax credit would disproportionately benefit mothers. And it's not only for workforce participation, but over lifetime earnings. So one of the things we constantly hear is women make 70% of men for the same job. Now, generally, this is not because an employer looks at somebody in the eye, sees a woman, and decides to offer them less. What has been found in the economic literature is women tend to drop out of the workforce for 6 to 7 years, or have a or they work less for 6 to 7 years while they're raising their children, right? And thank God they do. They make a tough decision to do that. But when somebody drops out of the workforce during prime earning age, which is usually your late 20s and 30s, that affects lifetime earnings, right? And so not only does it keep women from participating in the workforce, it keeps them at a lower income for the rest of their wage earners for the rest of their careers. So this was an effort to help address this issue, right? And really help women, help people with the anguishing decision on whether you should work or you should take care of your children, right? And this was a big push as well. Oh, and then there was the last one about supporting teachers, right? So the initial GAP plan had a $500 tax credit for teacher expenses. These are all the individual tax credit proposals that were in the original GAP plan. I'm going to go over a couple of them. Here's the first year's cost. So you'll see that, like, in total is all the tax proposals was about a little over $300 million, which is big in Hawaii. This was a tax. This is one of the most significant tax proposals in the history of the state. If this were to have passed in its entirety, this would have represented the largest individual income tax reduction in the last several decades. So I'm going to just go over like some key issues. One is the food and excise tax, right? So the food and excise tax is a refundable income tax that really helps lower income taxpayers. It's automatic, it's income based, and the initiative, the GAP plan, was going to double that. The EITC is another one. It's called the Earned Income Tax Credit. This is offered at the federal level. It's generally acknowledged as the single biggest poverty alleviation tool offered by the federal government. The Hawaii matches this to 20%, and they made it refundable 2 years ago. The original proposal is to increase this from 20 to 30% of the federal EITC. And we're going to talk about that later. The Child and Dependent Care Credit, which I spent a couple minutes discussing, and its rationale was the guts of the proposal is actually to increase allowable expenses from $2,400 and $4,800 for 2 children to $10,000 and $20,000. So this is a massive increase in the tax credit, and people would be able to claim qualified expenses of 50%, where most people right now can only claim 15% of all tax credits. And so you can see this one, the food excise tax credit, the EITC, and the Child and Dependent Care Credit were the largest. I'm not going to go over too much into the credit to low-income renters. We can do that later. It was eventually taken out of the proposals halfway through the legislative session. It's kind of a complicated credit, so I'm not going to go that much into it, but we can go into it later. The other aspects so these were just your traditional credits, right? Income-based or activity-based credits. The other aspects which was going to index the tax brackets to inflation, standard deduction, personal exemption. It was also going to increase the standard deduction from 2,200 to 5,000 for the single filer, and really increase the standard personal exemption. Those are what you can see here is these are more expensive proposals, and the reason they are that is they're available to more people. The personal exemption disproportionately benefits families, right? Because they tend to have more exemptions. And then the standard deduction tends to benefit people on the lower part of the income spectrum because they're more likely to take the standard deduction versus the personal itemized deductions. And we can talk about that more. The other really big push from this was to index tax brackets and index the tax system. So just to put this in, give some background information. At the federal level, all of our tax brackets are indexed to inflation. Most other states have tax brackets. If they have tax brackets, are indexed to inflation. And the reason for this is, generally after 1 or 2 years, traditionally when inflation was between 2 or 3%, it's not that big of a deal. But over time, over 20 or 30 years, everybody gets pushed up into higher and higher brackets. This is called bracket creep in tax terminology. And what that means is that more and more people are in the highest tax bracket. So just to put this in perspective, and I have a graph on this later, but I think it is really important to think about, is the highest, before we passed the highest tax brackets for 9, 10, and 11% in Hawaii, that was 4 years ago. The highest tax bracket was 8.25%. Now that goes into effect at $48,000 for a single filer, which most people do not think is very high income. Why is that? Why is that the highest income tax bracket? It's because it was all changed in the last time we really fiddled with things was in the 1980s when $48,000 was a great salary. Right. So what happens over decades, more and more people get pushed up. And so this is an implicit, like it implicitly raises everybody's taxes. And this was a proposal to come up with a mechanism, which is all over the at the federal and at other states, to really just benchmark everything. So things wouldn't get pushed up. People wouldn't be pushed up into higher tax brackets because of inflation. So again, I broke these down into different components about thinking of the GAP plan. There's a couple things. I'll just go over again because I mentioned all of these, right? The first one is updating the income tax code. And so this is the indexation to inflation, which I just discussed, but it's also increasing the standard deduction and the personal exemption and all these limitations that are defined, right? So all of these were once created, usually in the 1980s, early 1990s, and they really haven't been adjusted since, even though most things in the economy cost more. So that's updating the tax code. The other thing is income support to assist families, and those go into 2 different categories. One is the EITC, the lower income renters credit, and the food excise tax credit. All are income-based tax credits, right? And then the standard deduction, personal exemption, those are more across the board. And then finally, we have the child and dependent care tax credit, which is supposed to help working families and boost labor force participation. So I just showed you this a couple slides ago. This is where our current tax system benefits. This is what it would be for if the GAP plan had passed in its entirety, right? So a couple things I want to point out here. One is the people at the lower income spectrum went up substantially, right? And these are because of increases in tax, the food and excise tax credit, the EITC, and they do benefit from increases in the standard deduction, which exempt more and more of your income from taxation, and the personal exemption, right? But the other thing that's really important is these middle income deciles were supporting things. And a lot of it comes from the personal exemption and the standard deduction and the child care tax credit, right? So when you have income-based limitations on tax credits, you are going to favor, usually you're going to favor, in Hawaii, we decide to do it to our lowest income earners, which is totally understandable, but that goes to the lowest people. The reason why the GAP plan needed a number of different tax proposals, not just one, is because we were trying to target and benefit different parts of the Hawaii's population, right? And in order to help different parts of Hawaii's population, you had to have different tax credits, and manipulate different aspects of the tax code. So this is an example of people's taxes. So what we did here is we take a family of 4, taking the standard deduction and only taking income-based tax credits, which would be the EITC, the food and excise tax credit, and looked at what is their taxable tax liability, right? So the first line is their income. So this is what they would imagine. The second one is their current tax burden, right? So the lowest under our current system, that a family of 4 making $12,000 a year would receive $1,400 back in refunds. And the top a family of 4 making $188,000 would pay $11,000 in taxes. After the tax bill, we would reduce things substantially, right? So if you look at the differences down here, you'll notice for the lowest 2, the difference was over $2,000, almost $3,000 in some cases. And this did not include the child and dependent care tax credit, which was one of the largest tax credits that could go up to $10,000. So what you see there is this is really meaningful tax reduction, especially for people with low incomes, right? And so this is the boost to their incomes. This is a 20% boost in income to the lowest 20% and almost 10% for the second. So this is really meaningful reform. This is just another way of looking at the meaningful reform. So this is the effective tax rates for different quintiles of the population. And what you'll see is, for the lowest, everybody gets a tax refund, right? So their tax liability is 0, and it increases a little bit, and it actually increases all the way through. So this is exactly what a progressive tax system is, which is the more money you make, the more taxes, effective tax, the bigger the proportion of taxes you pay relative to your income, right? And I just want to highlight, so this is the current one. If we had just did a exemption on food and medical care, this would be the benefit to all taxpayers, right? So there would be some type of benefit, but it wouldn't be very big. And this is for the same price, right? So the same amount of revenue reduction for eliminating the tax on at-home food, that costs about $350 million. So we're talking about, we're in the same ballpark for the Green Affordability Plan and the reduction on food and medicine. And so the green line is the Green Affordability Plan. And so what you see is like, it's a totally different ball game. It reduces people's tax liabilities substantially compared to everything else. I'm going to skip this, but this is just another way of showing total and absolute taxes. What you'll see is the green line, which is the Green Affordability Plan, moves the dial more than just about anything else. And so this is our current tax plan, and this is what would happen with if we had an exemption on food and medicine. And the reason I kind of skip over medicine is the state already provides an exemption on prescription medicine. So this would only apply to at-home food and over-the-counter medications. So why are we even talking about taxes, right? Like, is this a big issue in Hawaii? And so one of the things we did was we looked at, like, it's very difficult to figure out tax liability across states, but we spent a lot of time doing everybody's taxes in every single state in our office. And what we found was somewhat surprising. So we were looking for a tax liability for a family of 4 with the AGI of 88,000, which is the median income in the state in 2022. For that liability, Hawaii has the second highest tax liability of any state in the country. The only one that's higher is Oregon, right? And Oregon does not have a sales tax, right? So we have the GET, which is pretty hefty. The Oregon is the one that's higher, but they don't have any sales tax. Everybody else is lower. Now, even like states like California, which we think is like a high tax state, is down here. And why is that? It's because we're looking at the 88,000. So one of the things that's really unique about Hawaii's tax system is we have a lot of different bracket levels, but all the bracket levels are at the very end of the, like, they're all around between $30,000 and $50,000 because they haven't been updated, right? And so this really increases the tax burden. If the Hawaii GAP plan had passed in its entirety, it would have reduced tax. It would have shifted Hawaii's position down 2 extra levels to number 3 versus being at or to number 4 versus being at number 2. So this was meaningful tax reform, even for middle income taxpayers. Just to give you a position, this shows Hawaii's ranking for all the 41 states that plus DC that have individual income in terms of their tax liability at different income thresholds, right? And so what you'll see is we're either number 1 or 2 for all different types of, this is for single file, or this is for married filing jointly. And what you see is, you know, we're number 1 or 2 for all of them. And if the Green Affordability Plan had passed in its entirety, it would have moved our rankings down substantially, right? So for example, we would move from 3 for a family of 4 making $50,000 to 16. So it would have moved the needle in just about every single case. So what actually happened, right? The GAP bill started off, and I'm gonna just walk you through what happened in the legislative process, because I do think it's interesting. Oops, I'm sorry about that. I think it's interesting, and it says a lot about how our legislature works. So everything was in the original bill, which is HB 1049. They split out the legislature. So the governor proposes the bill, and then the legislature can do what they like, right? They can pull out different parts. They can reform the bill as it goes from one chamber to the other. So the chambers, as it did crossover, pulled out the bills into 2 different things, right? They had actually 3 different bills. They had the food and excise tax credit. They had all the other tax credits in HB 1049, which is the teacher supply credit, low-income renters credit, and the child independent care credit. And then in the 954, they had a EITC, which they left out the amounts, and then all the other tax reform, which was like the indexation to inflation, they increased the standard deduction, all those things. This was the HB 954 was moving down the pipeline, and then you know, on the very, very, very last day, 2 hours before the legislature session ends by mandate, they passed out the bill, right? And the committees passed out the bill. And what came out of this was the EITC going from 20 to 40%, so doubling of the EITC, double of the food and excise tax credit, and they passed the child and dependent care tax credit, but they only passed one portion of it. So it ended up being a very, not a very significant tax credit in the end. So we'll talk about that. These are the main provisions. So now it's called, it went from HB 954 CD1, which is the conference draft 1, to Act 163 because it's been signed into the governor. So these are the high headline numbers, right? So the EITC was increased from 20 to 40%, providing $50 million, an additional $50 million to working families, doubles the food and excise tax credit, and increases the income limitation by 10,000. by increasing the income limitation, another 90,000 people are going to get this food and excise tax credit, right? And this can be meaningful now, right? So the tax credit, I think, is $220. It's a maximum of $220 per exemption. So if you have a 4 or 5 exemptions, 6 exemptions, this is over $1,000 tax credit, right? And the refundable earned income tax credit could be as well. The child and dependent care tax credit, what happened is they increased the allowable expenses from $2,800 and $4,800 to $5,000, $10,000. However, they did not increase the percentage of the taxes. So most people can only take 15% of all of their child care expenses. So it really lowered the size of the tax credit, but it did increase to $3,000 from, I think, the maximum credit before was $1,200. So yeah, there was still an increase. So I'm going through this again just to kind of show you what happened and what are how the evolution and who really benefited from all these evolutions, right? So again, this was the tax code that existed last year, right? So most of the tax benefits going to the lowest incomes. This is what the original Green Affordability Plan was done, and this is what Act 163 does. And so what you'll see is because it really focused on increasing the EITC, that's where a lot of the gains came from in the food and excise tax credit, right? But it really missed a lot of the Alice families. The child dependent care tax credit did pass, but it's a smaller version, right? So instead of being a tax credit that would have been benefit people on the order of $80 million, $90 million for the whole entire state, it was something like $11 million. So really, you know, we're talking 13, 14% of the original intent. And then this is why it's smaller. HB 954 or Act 31 is meaningful for the lowest income people. So this is just another, this shows how we're ranking compared to other states. What you'll notice here is nothing changed over $50,000, right? We're still the same. We were 2 before, 2 after, 1 and 1, 2, 2, 2. It was the lowest income people that benefited. So we went from 2 to 4 for a single filer and from 3 to 12 for married filing jointly, right? So you can really see where these important tax credits were falling on people. This is the impact to revenue, right? So the EITC is around $43 million. And the food and excise tax is 35. Child and dependent care tax credit is much smaller than that. So that's what passed. The governor is still interested in doing more. Of course, given a lower, or we can talk about what may or may not pass and what are the dynamics going forward, but like the biggest things are, there's a couple potential next steps. One is they could amend the legislation to give the full tax credit for the child and dependent care tax credit, right? Would really turn the child and dependent care tax credit into like kind of an afterthought for working families to something that would really affect their decisions on whether to work or not. So that could pass next year. They could also do generalized income tax relief, which is the increased standard deduction or the increased personal exemption. And then there's the inflation adjustments, right? And these are the ideas that you can index different aspects of our tax code to inflation, so people don't get pushed up all the time. Here's what I was talking about before about bracket creep. Right. So this is why the inflation adjustment matters. So you can see that like we do have a bunch of different tax brackets, but they all go up around, you know, they start around $10,000. This is for a single person, right? So you can think of this in terms of their own income. And then, you know, one of the top tax brackets goes into effect at $48,000, right? So most even the average middle-aged person makes more than $50,000 in Hawaii. Just to put this in perspective, the minimum wage in Hawaii is right now it's 12, but I think the average, most people make over 15. It's easier to make over $15 an hour. If you worked at $15 an hour full time, you would make $30,000, right? So putting that into perspective, we're already taxing somebody almost at the highest rate at that rate. And then all of this is because of inflation, right? So this all gets jumbled together because in the 1980s, these were good salaries, right? But in 2023, they're not good salaries. And so that's the whole idea of bracket creep. Okay, so to go back to what are the next steps, there's a couple things that the governor needs to consider. One is the amount of fiscal space. The fiscal surplus that existed last year is much smaller than now than it was before. There's also the concern about the Maui wildfires and rebuilding and that entire tragedy, which the governor has to consider now as well. And he has to weigh tax credits or tax cuts, which is a form of revenue reduction, with other priorities in his administration, which are spending priorities, right? And so that's where we are. I think the governor has expressed interest in all these different avenue paths. Whether what he decides to do in the end is entirely up to him. So I'm going to end there, and we can have a detailed discussion about any part of that presentation.
Thank you very much, Seth. So I think we have a question from the Q&A section. So I will read that one, and I would also like to urge everybody that can to participate and ask Seth interesting questions. So the first question says, what factors were influential in the legislature's decision to keep the scope of the tax relief system relatively small? And maybe to rephrase it, or like to add up another question that I had in mind was, why did we see the scale down of the benefits of coming from the government's proposition to what actually passed through the legislature?
Yeah, okay, so cards on the table, it's a legislature, and the minds of the legislature are black box, right? So this is a lot of, I will report what I saw. The nature of how things work is the government makes a proposal and the legislature steps in and enacts the laws, right? So it really comes down to the legislatures and the two most important legislators in all of this are the heads of the money committee, right? And that is the head of the finance committee, and that's the head of the WAM, which is the Ways and Means Committee. There was a couple of questions. One is, I don't think there was a lot more political appetite to help the lowest income people versus middle income people, which is one thing that I heard cited a lot. Two is they became very uncomfortable with long-term structural reform because they liked the revenue, essentially, and they were uncomfortable with it. There might have been some misunderstanding about what finally passed because tax legislation is actually complicated. And when everybody's doing it in a rushed manner behind the scenes, not everybody understood what was going on until the very end. So I would say those were the three big ones. And also the legislature just had other priorities, right? So it's either spend or reduce your taxes, and they chose to spend.
So a related question that I have is, so yes, the changes in revenue is definitely very worrying if you're in the legislature and you got to figure out, okay, if we get this tax cut through, how are we going to fund our budgets? But then the question is, we saw that Hawaii has like some very high income tax burdens compared to other states. Maybe in your research, have you looked at how other states are financing their budgets? Do they use other types of taxes, maybe?
So yeah, I mean, they use, one is Hawaii just spends a lot relative to their GDP, right? So that is a political decision that the people of Hawaii have made. The other big thing that we have in Hawaii, and one reason our income tax is higher, is because we have relatively low property tax. So property tax is the domain of the counties by constitutional mandate. And that means that all of our education systems are basically funded at the state level. So we have higher fiscal responsibilities, spending responsibilities placed on the state level than in most other states. But we do not have access to the classic means of financing that, which is property tax. And that means that we rely on everything else.
I see. So I guess another question related to that is, given what passed, do you think that there would be a meaningful change in the housing affordability for the state in terms of like owning and renting both?
So the owning and renting property tax has a much more direct impact on that. And that is the issue at the county level. Just to put things in perspective, even for residents, the property tax is relatively low. So it's 0.3% of property tax, where in a lot of other jurisdictions, it's closer to 1%. So like 3 times higher, right? I do not anticipate that any changes to the tax credits, particularly for low income people who are less likely to own, will have any meaningful impact on the housing prices in the short term.
I see. I was probably envisioning something like maybe income tax credit for interest paid on mortgages, especially with the high interest rates that we see right now. But that's likely to benefit disproportionately more higher income people than
Right. And there's a debate about whether that even helps people. There's a long debate about whether that even helps homeowners, because home ownership rates in countries that do not have that tax exemption, they're around the same. And so there is, from the most economists would agree that what you're doing is just driving up home prices, because everybody can afford a slightly more expensive home, and it doesn't really boost home ownership.
Yeah, I agree. Okay, we have another question, and that is, how do you anticipate the Maui wildfire impacting the state finances?
It's kind of like the $1 million question, or the 30 or 150, $200 million question right now. I think that it can go a number of different ways. And it all depends on decisions that the state is making right now. If the state within a month and a half takes care of everything, is able to house people relatively quickly, and get tourism back within a month and a half, I think it would be pretty minor. In fact, the amount of all the aid, everything that's going to Hawaii right now, or Maui right now, to help with alleviate all the suffering, is taxed, right? The TAT, the FEMA, all the federal governments are paying TAT, all of that. So in terms of, as long as there's a transaction, the state of Hawaii will tax it. The bigger question, and a lot of the tourists are being displaced to other islands, right? And so one of the things to keep in mind is we do have a dynamic economy and people are making choices. So just because you see all the devastation in Maui does not translate to economic loss. And presumably a lot of the things are insured and things will come back. Now, the bigger question is, how quickly are we going to respond? If people are able to, get back, utilize these hotel rooms and stuff relatively quickly, and we can get the people who've really suffered into longer term housing solutions, I think it's not going to be that big of a deal. If our permitting doesn't allow people to rebuild, housing prices, like people are dislocated and wandering around West Maui, and West Maui remains closed for another 9 months, that it would have a large impact on our finances.
Thank you. I guess since we're talking about tourism, so how do you foresee a change in the taxes on food impacting tourism? Would that be like something that tourists would even care about? Is there demand for Hawaii vacations elastic to the price of food here?
Yeah. Okay. So that's a great question. So thanks, Miro, for bringing that up. The reason why the the GET exemption on food costs just as much as the original GAP plan, but basically benefits nobody, is because a lot of those benefits are going to tourists. Right. So anytime you see the tourists going through Costco, you see the tourists buying at-home food, they're a big supplier, right? And so generally we like to tax our tourists and ensure that they do that. Most people do not mind. Like, one of the interesting things about the GET is it's 4%. So people don't really feel it, right? There's this issue called tax saliency, which is the more you realize you're paying a tax, the more you will change your behavior. And 4% is low. So it's just charged at every single point in time. So people don't really, most people in Hawaii don't get all up in arms about the GET, right? They get up in arms about different aspects where something is more salient. So it's one of the reasons why we discouraged, I mean, I would discourage people from exempting the GET. It creates a lot of administrative problems, but it also did not really benefit residents. The other thing about just it's not going to draw in more tourists, because one of the things that I think is pretty well understood is most tourists have a set amount of money that they want to spend on their vacation, right? So if you increase hotel prices, they just spend less on food, right? And that's generally how it works. I mean, it's a little bit more complicated model than that, but if you think about, everybody has a fixed budget for their Hawaii vacation, you can make a lot of good policy decisions just based on that. So if you lower one aspect of costs, yeah, they'll spend a little, but they're not going to decide to come to Hawaii any more or less for a change in 4% on food.
That's a very interesting point. And I guess those relates to the other taxes that the state has on, say, like resort fees or like rental car taxes.
Right. So the TAT is a really interesting topic, right? Because people keep and this isn't just Hawaii, but voters love to tax anybody but themselves, right? Like, that's the mantra. And so in Hawaii, not all of us don't think of ourselves as tourists, even though we all go to neighbor islands sometimes. And so we tax TAT. TAT it's really interesting. Like, are you just taxing the hotels, or are you actually taxing because are you just saying that the hotels can't charge quite as high as a price now because of the increased TAT? And that generally tends to be the case. I mean, it's distributed in both places, but when we do raise taxes, we're kind of taking from Peter to give to Paul.
I see. Okay, I have another question from the audience. So is there any way of getting the legislature to adopt indexing?
Yeah, you just talk to them and write in and say this is really important, and they'll vote on it. And the thing about indexing is it's new. We have a understandably and probably good, like, they're fiscally conservative and worried about the long-term implications. And the thing to think about indexing is, like, over the budgetary window, which is 6 years, it's essentially zero. I mean, it got bigger in last couple of years because we had inflation at 9% for the first time in a lot of our adult lifetimes. But the expectation is it's going to be between 2 and 3% going forward. So it's small. It's actually a small thing in the short term. It's just in the longer term, it becomes a bigger issue.
Yeah, it just sounds like something that's going to save legislature time 20, 30 years down the line. So
right.
That you have to re-vote on those income brackets. But I guess it remains so that the income brackets are what they were before.
Yeah,
so,
and in 30 years we'll all be in the 11. In 30 years, most, like, $300,000 would not sound like an insane salary. And like, school teachers will be making $200,000, and everybody would be like, oh God, school teachers can only live on $200,000, which sounds insane to us, but that's the nature of inflation, right? And they will be taxed because we do not increase. Hawaii does not like to reduce taxes, so we'll get pushed up into the higher rates, most likely.
Thank you. Another question. Are you concerned about the fire's impact to HECO? And what will it mean for all residents and the state of Hawaii to have a potentially bankrupt utility?
Okay, so that has nothing to do with my professional job. right? I'll answer this as an economist, but nothing like
I
as
guess
a
it's not going to affect the budget
yeah.
by
I like. I mean,
roughly
I don't think it would. What
how
I
people.
think is like we're users, right? So if you increase the cost of doing, if you increase the risk and liability of everything that HECO does, I would expect them to want to raise the rates because they have to insure themselves against future losses, which is their regulated entity. They can consult with the PUC. So I would expect that just to raise our income or our utility rates. In
But
some way.
you don't foresee a situation where the state would have to come in and kind of like backstop
I
to.
don't think so, because they're national. I don't know. That's totally. I have no idea.
I don't know either. So I guess we both have homework.
Yeah.
So
Well, the
has it
lawyers do. I mean, that's a question of like lawyers, right?
absolutely. Has the administration indicated whether it intends to pursue the parts of the gap that it didn't pass this year in the next legislative session?
Yes, the governor has explicitly said he's interested in passing certain parts, and he's looking at the fiscal surplus and coming up with his own agenda and deciding what to do. And a lot of that will depend on the Council on Revenues meeting that's going to happen in September.
Thank you. Has there been any discussion in administration about decompressing the tax brackets in terms of what that bunching that we saw in the beginning?
No, there has not.
Because effectively there is very little difference between. I mean, there's going to be very few people that are going to fall into one specific bracket there.
Yeah, and there was two ideas about this, right? You can either affect the standard, like mess with the personal exemption or standard deduction, which reduces the amount of taxable income, or you can mess with the tax brackets, right? So you can think of like, you have a number of different levers that you can achieve similar means. The standard, going for a standard deduction personal exemption was, we knew was going to help out lower income people explicitly. And there's adjusting the tax brackets is a much more explicitly political decision. And because you have to decide who's going to pay what and how things. And I don't think anybody, I haven't seen anybody really bring that up that has seriously considered that.
I see. So I think you mentioned earlier that there was this barrier to understanding the tax code because it's quite complicated, and especially when you have to pass it through like very short amount of time. So there's a question that I'll try to rephrase a little bit. Do you think that maybe we could benefit from tax reforms that are a little bit simpler, so that it's easier to understand what the reform entails and what you're voting for, and like what this how would this impact the state and the budget?
Probably not. So for a number of reasons. One is just to go back to the, if you can imagine the slide with all the different income, the benefits by income level, you needed to have like we have a complicated economy, and you probably have to have complicated tax reform. To be honest, I don't find the tax reform very complicated, but I study it for a living, right? And so it is very normal to have, like, I don't understand environmental legislation, but there's a lot of people who know the back of their mind. So it's very normal to have professionals weigh in on the tax on laws and give an honest assessment. And we have a, this incredibly diverse and modern economy. And we should probably have a tax code that's not overly complicated, that can be manipulated for people's gains, but needs to be addressed. And the third thing I would say is the people don't really care about tax, how they get their money back, or how many tax, or why they're paying taxes. What they care about is the amount of taxes. So if you really refund people $2,000 a year, they don't care if it came from this one or this one. We can fight amongst ourselves as legislatures and decision makers, but that is our job, right? To have a somewhat sophisticated decision. In 2 or 3 years, everybody would have gotten used to the changes in their income. And that's what's most important. And that's what's going to affect their spending decisions and how they adopt their lifestyle in 2 or 3 years down the line. And that's what we're focusing on.
Thank you. So if I remember your slides correctly, The biggest loser from scaling back the tax reform were these Alice families.
Mhm.
Do you think that there may be some alternative ways that we can address that? Maybe propose some alternative tax changes that would benefit these Alice families, in addition to what the governor proposed that didn't pass?
I mean, what you see here is look at what benefits these families. It's a standard deduction and personal exemption, right?
Mhm.
Because you're basically exempting more of their income. You can mention, you can mess with the tax codes, but that affects everybody, and it's even more complicated to deal with it, right? If you have tax credits, most people don't. There's not a lot of political appetite for tax credits for people making less, for people making $100,000, right? So really, we've a lot of policy making is figuring out what's possible and using the instruments that exist. I'm sure I could sit down with a number of really smart people and figure out a completely new tax credit that would accomplish this. But we have the tools to accomplish this already through adjusting tax brackets, personal exemption, standard deduction, and even the child and dependent care tax credit. That's really a meaningful reform. So we chose to use the existing ones. And as far as I'm concerned, those are the existing ones that are most likely to affect that. And there's no other policy alternatives.
I see. Okay, I guess I would have one final question for you. So if the there is one more question from the audience. What impact would a higher minimum wage have? Hawaii is 25% below the highest state level in the US. Let me see. So what impact would a higher minimum wage have?
It would probably not have much of an impact on tax revenues, because I think 70% of our taxes are paid by people making over $100,000 a year, right? So the huge amount of taxes are paid by what we could, I consider myself middle class, right? But like but I'm nowhere near an Alice family. But I pay a lot of our taxes here, but I'm a state worker, right? So I don't make that much money. But I don't expect the revenues to go up. I do think, like, one is kind of what you're saying, and demand in periods of high demand, the minimum wage is irrelevant, right? People are paying 18 above the minimum wage because they need it, right? And so that's the whole idea of economists thinking like, no, you want an adjustable labor force, that when there's like scarce free people, you hire more and people get higher wages. And then when like you don't have as much demand, you can adjust it. The other thing that minimum wage does is you have to think about how it affects the entire economy, right? So if you want to, one of the things that is always high on the priority list is agriculture and being self-sustainable in agriculture. Well, I can tell you, high minimum wage, high laboring costs does not mix with agriculture. You are just killing that. You're killing that. And for minimum wage, sometimes what works best is by municipality, right? So it probably is more appropriate for Honolulu to have a higher minimum wage than it is for the Big Island to have a higher minimum wage. And adjusting that and having a flexible approach to that may be something to think about.
Absolutely. You mentioned that lower income families are less likely to itemize their deductions. Why is that the case?
The easiest way is, so there's two big itemized deductions that like most people, I mean, the super wealthy people can do different things, but we have laws to limit higher income people's how much they can itemize their deductions. But essentially there's taxes paid to the state, which you can deduct. And then there's your interest rate deduction. So if you own a home, particularly in Hawaii, presumably you're paying a lot of interest. So that is part of it. You also get your property tax. So property owners tend to itemize their deductions and other people do not. That's not, it's kind of like a good general law. And because we have a very low standard deduction, 2,200, I think the federal government for single people is like 10,000, like around there, right? So it's much higher. So more people itemize deductions in Hawaii because we have a low standard deduction. If we had a higher standard deduction, more people would take it.
Absolutely. Thank you. And then there's one more question from the audience. That is, how will the sunsetting of the TCJA in 2025 affect the state and our residents?
That's a tough one. Again, it depends on what sunsetting, right? So presumably all of our taxes are going to go up if the legislation doesn't change. Usually that doesn't happen. Usually people, even Democrats, will, I mean, look at Obama. He kept the tax rates for like all but he kept the tax reductions for all but the super higher income people. So that would probably do the same. I would say that we are in a very different fiscal time now than we were in 2017. So in 2017, we had really low interest rates. We could borrow as much as we want. We're farther off. The pandemic spending, the inflation, and essentially higher interest rates has really changed the fiscal position of the federal government. And it has basically brought this reckoning of the Social Security and Medicare and all these things up about 8 years closer to reckoning time. So another possibility in 2025 is we don't do anything, we raise taxes because we need to. And like all of our tax liabilities go up.
See. Okay. Thank you very much. And
thank you.
Okay, maybe we have time for one quick answer. Okay, so we have like a couple of minutes. There's one more question. Hawaii has had 7 years of population drop with 15,000 people living in 2022 alone. Business already cannot find enough workers, and some have closed their doors because of that. So this question asker imagines that this is affecting Hawaii's GDP. What are the thoughts about this out migration? What did it mean for Hawaii and Hawaii's budget, I guess?
Yeah, I mean, it's a very serious question, and a part of the governor was trying to use the Green Affordability Plan to help address this issue. So one of that is Hawaii is super expensive, but not only is Hawaii super expensive, we pay a lot more taxes than everybody else, and working parents have higher childcare costs than the rest of the nation. So addressing, I mean, it all comes down to, we have lower wages and higher costs than the mainland, and people are voting with their feet, right? And so if you want to address that, we have to build more housing. And how you do that is people are looking into that, but you have to lower costs. So that's taxes, housing, and different things. And I don't anticipate anything changing until that happens.
Thank you very much for this wonderful discussion and for sharing your thoughts on the tax plan and what passed through the legislature. So I'll give the word back to Leslie, who has a couple of announcements before we leave. Thank you.
Thank you, guys. Appreciate it, especially both of you, Seth and Miro. Appreciate your coordination of today's event. And thank you to Mary for her technical support, also the support of the promotional initiatives. As we finish up here, I want to thank everybody who joined us today. And I'd also like to personally invite you to join us Friday, October 13th for our annual conference. We'll be exploring policy decisions, that have become reminiscent of Groundhog Day, little deviation in the decisions year to year. If you joined us last year, consider this a continuation of those discussions. And if you're joining us for the first time, it's a great opportunity to get involved in these discussions on our local economy. Similar to last year, we'll also welcome attendees to join us for an informal pauhana after the conference concludes, and those details will be released shortly. One more thing before you go, please complete that feedback form for today's event. You can find that link and the QR code on your screen, as well as we'll drop that in the chat, and we'll also provide that in an email. Please take some time to fill that out. We do read over those, and we do take any suggestions to heart. So please take some time on that feedback form. With that, a big mahalo to our returning attendees and those attendees who are joining us for the first time. As you know, as I've said before, we've strived to make our events relevant and beneficial to Hawaii's diverse business community by tackling topics that are pertinent and breaking them down to be accessible to a broad audience. We hope that you found this to be the case today, and we look forward to your feedback. Thank you so much for your time and attention. Aloha.